And so much of what we hear in the press about, the EU is they're going to stop importing Russian oil and they're going to stop importing. I mean, it's crap. I mean, they're absolutely incapable of doing it. Most of what they're talking about is formalizing what has already been done to them. That's what they're doing.
Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Oil prices have nearly doubled since December. They're definitely a substantial contributing factor to the hot inflation that continues to rage across the globe here at the start of summer, at least in the Northern Hemisphere, in 2022. Summer, of course, is peak driving season. Does that mean oil prices are headed even higher in the near term? And what about the long term? And has the West's embargo of Russian oil permanently changed the game for oil prices? If so, how? For answers, we turn to petroleum geologist and energy expert Art Berman, who kindly agreed to come back on the program after so many of you viewers asked if we could hear his latest insights on the oil situation. Art, it's great to see you. Thanks so much for joining us today.
Always good to talk to you, Adam. Thanks for having me back.
It's a pleasure, Art. I wanted to have you back on for a long time to kind of get into the larger sort of fossil energy discussion that we ended on the last time you were on the show. Unfortunately, things have just been so darn busy. Haven't been able to bring you back on for that. And I want this show to be specific to oil if possible, just because there's so many questions around it right now, given how high oil is spiked. So before we get into the details of that, though, if I can just at a very high level ask you, what's your current assessment of the oil market today?
Well, oil markets are tight. That's a popular word among analysts, simply meaning that there's there's not a lot of give and take between supply and demand. So when somebody wants to buy a physical barrel of oil, it can be found, but you may have to look around for it to get it at the right price. So we've got a very, a rather, kind of a seller's market, if you want to think about it that way. And so, like with any seller's market, depending on how much you need a barrel of oil, or you need a new SUV or whatever, you may have to pay more than you originally planned to get it. So that's the way the oil market has been before the Russian invasion of Ukraine. And so with all that going on, of course, that just kind of amps up the intensity of the whole thing. My sense is that we're at $120 for West Texas Intermediate U.S. oil, and we're a little bit higher for international oil or Brent. I could be way wrong, but I think we're bumping up against at least a resistance level for the near term. And so one of the things we'll hopefully talk about is that oil markets are not some sort of magical thing, and that prices can sort of just become whatever they want to. This market doesn't have rules, but it does follow certain patterns. And just because somebody gets on Squawk Box or Kramer or whatever and says, oh, oil's going to go to $200 a barrel, well, it may get to $200 a barrel, but it's very unlikely that it'll get there like in 3 months or 6 months. I mean, these things take time. And in my view, I don't think it'll ever get to $200. I'll probably be wrong since I just said that. But that's my sense of the way price formation works in this market. So I don't see price going down a whole lot. I don't, for the near term, seeing it going up much more. And I would be cautious because there are always a lot of rugs to pull out from under this thing. And we're right now just kind of in the exhilaration of, the Chinese COVID lockdowns are over, so China's opening up, and oh my God, think of all the great things that that could do, and demand is huge, and there's more oil coming out of Russia than we thought, and so there's this general optimism that things are looking pretty good, but there are a million little pieces that can be pulled out, and all of a sudden this Jenga game collapses on us.
Yeah, absolutely. And maybe we'll talk a little bit more about some of those potential rug pulls in a bit. You sent over a bunch of charts. I want to walk through at least a couple of them, Art, because I think they're going to make, they're going to build on what you just said there. Some of them are coming from a report you recently released called Oil Demand Destruction is Inevitable. And one of the reasons why I think this is such an important piece is there's a lot of people right now, I think a lot of viewers of this channel right now, who are very bullish oil, as am I in the long run. But here I mentioned in the intro that oil's doubled basically since December. You're going to give us some more detail in just a minute here about some of the rules that constrain the oil market. And so having a runaway oil price, like you said, up to like $200 a barrel, while it's possible, it's very rare for a reason. And if we were to get to an extreme like that, odds aren't bad that we would not stay there for a long time, given those constraints. And so, correct me if anything I'm saying here is wrong, but I want to make sure that we're helping people not kind of jump on a bandwagon of, I don't want to say FOMO necessarily, but just, oh my gosh, I'm a big hard assets fan. Finally, oil's really moving. This is when oil is going to go to the moon. I'm jumping on here. Not saying to necessarily not make those investments. I'm just saying, make them understanding that maybe the biggest part of the move in oil has been over. And if we get demand destruction, well, that then more or less always leads to lower oil prices, doesn't it, Art?
Exactly. And so where I would start is it's not a question of if we will have demand destruction, because we will. It's a question of when it'll kick in. And I say that not because I'm fond of making statements of high certitude, but just because if you look at all of the cycles that have occurred in world oil markets since the 1970s, whenever we have a spike in oil prices, that always occurs with a spike in inflation. We can talk about chicken and egg there, but they commonly occur together. We always see demand destruction. We always see it, and so in a quantum universe, I suppose, just because you've seen it before doesn't mean that that the next time is going to be the same. But in a real world, the whole idea that this time is different, it just doesn't play very well over time. So we will have demand destruction, and then the next question is, when might we see it? And I'll tell you right away, I don't know. I don't think anybody knows. And how big will it be? How great will it be? I think we can put some limits on that, and it won't be trivial.
All right, so let's talk about what could drive that demand destruction. But before we do, let's talk about what's driving today's high prices.
What's driving today's high prices? I mean, you can get this on the front page of the Wall Street Journal or, New York Times or whatever. And that is that we are recovering from a global recession of extraordinary proportions because of the pandemic. And whenever, you can go back to the 14th century and look at what happens when plagues occurred in Europe, and whenever they do, there's always a shortage of labor. Supply chains are all busted up because they haven't been used for a while. A lot of the people that ran them have gone out of business, or they died from the plague or COVID or whatever. And so what we're seeing after COVID again is, it's playing out in the 21st century, but it's not really all that different from what has happened in similar kinds of periods of infectious disease in the past. So all of a sudden, demand comes back and supply is not there for it, and you don't just flip a switch and turn on supply. I don't care what it is. I mean, maybe you can do that with with your electric power after a blackout, but if everybody does it all at the same time, then there's problems with that too. So that's the underlying theme, I think, that is relevant here. So we were in a situation of very tight supply demand before the Russians invaded Ukraine, and when they did, that took several million barrels off the market almost instantly. And then, of course, the expectation of, oh my goodness, I mean, we don't know where that's going to go. And by the way, it's not just crude oil. Maybe even more significantly, it's diesel and gasoline that Russia provided and still does provide a lot of the refined products for Europe and Africa and the rest of the world. And so suddenly, somebody driving a truck in Germany wants to put diesel in it. Well, there's several 100,000 barrels a day of Russian diesel no longer available to it. Where's he going to get it? Well, it takes a while to figure that out. Maybe you have to pay a premium to get the diesel into Germany. So this is what's going on. The world was distorted because of COVID, and the Russian invasion further distorted markets, and not just oil markets. I mean, food markets and fundamental communication lines. I mean, it's. I mean, I would go so far as to say that what's happening today, which is kind of centered on Ukraine and Russia, is reforming the world order as we know it. That maybe sound a bit dramatic, but that's the way I look at it. And things will never be the same after COVID. I've said that many times when we talked, and after Ukraine, if there is an after Ukraine, they don't just snap back to the way they were.
Thanks. So you just went to my next question, which is, I was going to ask it mostly about the Ukraine war and the West's now, boycott of many Russian products, but particularly Russian oil and gas. Has that, plus I'll just lump the pandemic in there too and the impact that it had in the world, has that permanently changed the game for oil, do you believe?
In many ways, yeah, I think it has, and factor into that the investment trends, the ESG kind of environmental social governance, and a growing concern, certainly among investors, if not the public, about climate change and some of the things that we're doing to the planet. Lump all that together, and yeah, I think what I think Putin's timing of his invasion was made very mindful of many of these factors, but certainly energy. I mean, a lot of people don't know, but Vladimir Putin has a PhD in energy economics, and
I didn't know that.
Yeah, well, it's okay. There's a lot of things that energy is a complicated subject. So Putin wrote his dissertation about how the fall of the Soviet Union was fundamentally linked to the incompetence of the Soviet government to properly maintain its oil and gas production infrastructure. So here's a guy, and you can Google it, and there are plenty of people that say that he had a ghostwriter who did his dissertation, and whatever. Maybe true, maybe not, but my sense of this is that Putin probably knows more about energy and commodities than all the leaders of NATO put together, even if he did pay somebody to do his dissertation
Wow.
for him. And so the timing of this was okay. So Putin's looking at the world, and he knows we just got through COVID, and he knows everybody's oil and gas supplies are low, and that it's going to take months, if not years, to bring them back. He knows that the United States, particularly, is literally on its ass. All the shale plays are way down, and investors are not giving money, and credit is tight, and then there are demographic concerns. I mean, Russia has a declining population. They've got some of the worst demographics in the world. Very low life expectancies, high alcoholism. I mean, he had a really hard time raising an army. And you may have heard, I mean, he was out there basically asking for volunteers, from places like Syria and some of the Caucasus countries. I don't think that was public relations. It's not good PR anyway. So, I think Putin is looking at this, well, if not now, when? When is there a good time? And so much of what we hear in the press about, the EU is they're going to stop importing Russian oil, and they're going to stop importing. I mean, it's crap. I mean, they're absolutely incapable of doing that. Most of what they're talking about is formalizing what has already been done to them. That's what they're doing. And I don't want to. I'm not trying to be critical or sarcastic about the EU leadership. I'm just saying that. I mean, they're trying to frame this in a way that makes them look like they're actually doing something when there really isn't very much they can do at all. They're kind of screwed, and they're more screwed on gas than they are on oil. And the sort of chest beating that you hear about how the United States is going to come riding in with the white horse. I mean, that's crap too. We have in a tight oil market, we have very limited ability to increase our oil production. And if we did, the current administration wishes we would keep it all right here. Can we build new liquefied natural gas, liquefaction facilities? Yeah, we can. It takes a long time. It costs a lot of money. So basically what can be done right now is that we can divert shipments of both crude oil and refined products and natural gas from certain geographies and preferentially send them to Europe. And don't get me wrong, I mean, that's helpful, but it isn't exactly like we can just turn our back on Russia, we being the NATO countries. They desperately need that oil and that gas. So Putin knew what he was doing. Not a surprise.
Okay, and for folks that maybe want to delve even more deeply into that, I did an interview a couple of months back with David Knight-Legg, who inspired both the New York Times and a Wall Street Journal coverage of basically his thesis, which was that the Ukraine war was really an energy heist. It was less about NATO encroachment and less about sort of reclaiming ancestral, people back into Russia's fold, and it was more about capturing some of the remaining world-class energy resources that were in Ukraine's southern region there. If you're interested in watching that, I'll put up a link to the video right here. But Art, I'm just sort of listening to what you're saying, and I'm interpreting from that there's going to be this back and forth between the West and Russia for a long time going on. It's not going to be as cooperative as it was beforehand, but likely a full embargo is not likely to really be something that's feasibly going to last for an awfully long time because the West is so dependent upon those resources. So it's kind of some new world order.
Well, it is, and a lot of it is stealth also. I mean, so a lot of what's happening right now is that Russian tankers carrying Russian oil are transferring that oil on the high seas even to other tankers that will then take it to ports that were receiving Russian oil before, only now it's not officially coming from Russia. Or there are certain major oil companies who are blending diesel. So they're taking 49% of Russian diesel and blending it with 51%, let's say Nigerian diesel, and therefore it doesn't count as Russian diesel, and they can send it to Europe and not bust any of the embargo restrictions.
So it's a leaky embargo, but
there's no way to enforce it.
Yeah. So sort of the spirit of my question, though, is at least in terms of the dynamics in play going forward with Russia versus before the war. My assumption, based on what you're saying, is at least that component sort of sets a higher price floor for oil, because it's not flowing as unencumbered as it was before between Russia and the West. Now, there's lots of other factors going on, but it seems to me that the Russia one is setting a higher floor, from its direction. Is that accurate?
Russia's having to discount its oil sales. So it's sending a lot of oil, or a certain amount of oil, to places like India and places like China.
You're right. They're actually getting a bargain because it can't sell to us now.
Yeah. And then, those countries are not endorsing the embargo. And they're doing that for a lot of reasons. But one of the reasons is, China, hey, if we can get a $20 or $30 discount for taking Russian oil, well, that's a smart thing for us. We can put it in our storage, and that'll be just great for us. And by the way, countries like Italy and countries like Germany are now paying rubles for Russian gas.
Now, that's essentially because they have to. Russia's saying we're turning off the spigots if you don't, right?
Well, that's right. And so publicly, we'll never do that. That's ridiculous, but they're actually doing it, because
they're actually doing it.
That's what they have to do, right?
Okay, well, I'm glad you brought that up, because it really did show that I was just thinking too simplistically, which is kind of one of the reasons why we're doing this video, is I just want to prevent people from falling into a similar trap, right? You're right. The Russian oil gas may get more expensive for the West, but it's getting cheaper for the rest of the world. So you kind of have these cross currents going on. Before I get to the next question I want to get to on my list, just related to this, and I'll take a really short answer, but I imagine sort of another element in terms of the new world order around energy is China, in the sense that China's growth is slowing, right? And so, yes, it's opening up right now from having re-locked down, and there'll be maybe some short-term burst from that. But as we look out the next decade, the growth in demand from China for oil should be substantially less than the growth that it had in demand for the past couple decades, correct?
Seems inevitable, right? Sure. It's a maturing economy.
Yeah. Okay. So just underscoring, the path going forward may not look super similar to the path that got us here. All right. So you've written in your report, and you've mentioned a couple of times that you see oil demand demand destruction happening from here. So why don't I let you make that thesis?
Right. So the first thing, and we've got slides that that viewers can look at, but the first thing is, let's just get calibrated. Let's talk about oil price today, and the May average for West Texas Intermediate was about $110. And so, looking at the slide, I've just taken all the oil prices back to 1950, and I've put them in April 2020 dollars. And so when we do that, we see that $110 is a high price. There's no doubt about it. It's the highest price we've seen, nominally or real for the last 7 or 8 years. But it's substantially less than the peaks in 2011, 2008, and 1980. So there's two ways to look at that. The first is that oil prices are not as high as people want to think they are. A different way to look at it is maybe there's more room to run. Okay, that if the world was able to tolerate, the equivalent of $140 or $175 a barrel back in 1980, 2011, and 2000. Well, maybe the world can tolerate, that level again. Now, the world is different. We've got a lot more exposure to debt, so I don't want to get into that, but my sense is probably not. But but fair enough. I mean, we can do that. Another slide that's important to look at is looking at the correlation between inflation and oil price. And I don't really understand why economists seem to have so much difficulty understanding this. Maybe it's because they don't look at it. And I'm not disrespecting economists, but I listen to them, and they're talking about all kinds of really kind of fancy stuff here, money supply and labor flows, and et cetera, et cetera. And those are all. I mean, I'm not an economist, but I understand that, and those are all real. I mean, those are valid. But you look at this slide, and I'm just showing 2006 to the present, and I mean the correlation between oil price, which is in blue, and inflation in orange. I mean, it just doesn't get any better in the real world. Okay, I mean that is just as solid a correlation as you could ever hope for. And we can argue about which comes first, but as you know, my long-term observation is that energy is the economy. That money is nothing more than a marker or a call, a claim on energy. Life needs energy. All life needs energy. And the economy, we use money as a proxy for energy or work. Call it work. I mean, it is work. And so the fact that if the price of oil, being the predominant form of energy in the modern economy, if the price of oil goes up, then it only seems logical or reasonable that inflation would go up. And in fact, when you look at this graph, it always does. And I have other graphs that where this data is included, that you'll see that it goes back much farther. I just wanted to zoom in on this because this is the last 15 years of our lives. And so what we look at then is I have taken oil price and inflation, and I want to look at demand. I want to look at demand. I'm just looking at the United States right now, and that's not because I'm an American and I only think about the United States. It's because all of this data is available to me through the U.S. government and banks on a monthly basis, and I just can't get that for the rest of the world. I mean, I can get it for some countries and maybe even some groups of countries, but the United States is the world's largest consumer of oil, and by the way, the largest producer of oil. So the United States is not a bad proxy for the rest of the world. And so looking at this slide, what I'm showing here is inflation in blue and petroleum consumption, which is in red. And what it shows is that every time there's an inflationary spike, there is a decrease in our consumption of oil and the refined products that come from it. And those are pretty darn significant. I mean, in 1980 to 1983, U.S. consumption of oil dropped more than 3 million barrels a day. It's huge. It dropped a million and a half after 2008, 2009. I mean, these are substantial proportions, and we either don't remember it or don't think about it. And so the logic there is very straightforward, and that is that when oil price and the price of the gasoline and the diesel and the kerosene and all the things that come from it, when they reach a certain level, it causes us pain as consumers. And so we slow down our consumption. And the easiest way for most of us to save money is to not drive as much. And gasoline is, pretty nearly 50% of every barrel of refined crude oil. And so we all make these decisions and we decide to drive a little bit less, each one of us, and we decide to fly a little bit less. And in the past, take trains and buses a little bit less, and maybe order a little bit less from Amazon or wherever, which is all taken around in diesel driven vehicles. And eventually our consumption goes down. So that's just that's a fact. I mean, that's not a theory. And then, finally, I normalize all of those things, which is to say I take each cycle and simply, set the low to zero and the high to one, so that you can, really strongly see what those cycles are doing. And in this particular graph, I've got consumption or demand. It's not exactly the same, but it's close enough. In blue shading, I've got inflation in red, and I've got oil price in black. And I've got a little table in there that tells you, what the incremental inflation, oil price, and change in demand was for each of those cycles. And they're all different, and they last a number of years. But when I take all that and annualize it back down and say, well, on average, how much demand destruction occurs in a year for all these historical events, it works out to be something like, 700,000 barrels a day per year. And the average cycle is 2 or 3 years. So this is not a prediction, but it is it is an observation that says that I think that U.S. consumption of refined products could easily fall 500,000, 1 million, 1.5 million barrels a day over the next several years. And if the U.S. consumes 20% of the world, then multiply by 5. It's not quite that simple, but let's just keep it simple for now. And that says that world demand for oil could fall over a period of several years, 7.5, 8, 9 million barrels a day. And that's a big chunk. It's 10%. And so this idea that oil price can just keep on going up and up and up because supply is tight, if that were the only factor, sure. And then the final factor, which I think is really important, is what about the economic implications of this? And so the final slide I'm going to bore everybody with shows inflation, oil price, and again, we're talking US, and gross domestic product. And I'm showing in orange or yellow positive GDP growth, and I'm showing in red negative GDP growth. And what a shock that every time the price of oil goes up and inflation goes up, GDP growth goes negative. That doesn't mean that we're in a depression or a recession. It just means, well, it could mean we're in a recession. It just means what it is. I mean, again, this is empirical. This is just data. I didn't do anything to the data except present it. And so what does that, I mean, the implications of this are actually kind of chilling. I mean, there are a million reasons that you can hear economists talk about for why we could be seeing a recession sometime in the next 12, 18 months or whatever the window is. But what this is saying is you could easily see maybe not a recession, but some negative GDP growth simply because of the price of oil. No other reason needed. Why? Because it always happens.
All right. Well, great historical evidence here, Art. And, I kind of summarize it in my head by the old maxim that high prices are oftentimes the cure for high prices, right? It just gets too high that you start getting this organic demand destruction. To your last point there, though, you said you can make the argument nothing else happening, just oil prices staying at these prices, we're going to get that demand destruction. We also have the Federal Reserve right now with its foot on the accelerator, helping out the process, right? Every week Jerome Powell says, my job is to bring demand down here, right? So all I'd say is if you think it's likely just based on the oil data alone, I got to imagine with the Fed on your side, the probability of future demand destruction gets a lot higher, correct?
Absolutely.
Yeah. All right. Well, look, uh, you had mentioned that given these historical numbers, you can kind of make the case that from here we could see demand destruction along the lines of I'm averaging the numbers you threw out there, but about a million barrels annually for this, right? Or it's yeah, a million
Well,
barrels per.
less annually, but total.
Okay, totally, total. All right, so then that's at current, it's sort of the current supply situation. If demand might fall that much, if prices remain elevated like this, what is the current supply situation? I know you described the market as tight, meaning there's not a lot of price elasticity in the current market, I suppose. But are we in an aberrantly tight market right now compared to history?
Well, that's certainly what you would gather from the headlines. And for those of us that go a little bit deeper and read headlines that are specifically directed at oil traders and energy brokers and all of that, I think you might even get that message in spades. I mean that is the popular narrative. Now, I'm not in any way disputing or discounting that, but there are a couple of important things to take a look at, and I'll give you, three quick shots here, that kind of ease into this. The first is just looking at U.S. fuel consumption. So I'm looking at diesel or distillate, as it's actually called, and gasoline. Okay, those are the the predominant portion of what you sell from every barrel of oil. And of course, those are something that almost every American uses, one or the other, if not both. Maybe not directly, but if you take a plane or you order stuff by truck or take a train, you're using diesel whether you have a diesel vehicle or not. And so what this graph shows, it's an incremental presentation. So it's showing gasoline and diesel or distillate consumption demand, if you will, compared to the low point in the graph. And it doesn't change the data. The numbers add up, right? Because I add in a base at the bottom. It's just a way of making it more obvious what's happening. And what you see real obviously is the left two-thirds of the graph from 2015 to 2020. The additive gasoline and distillate consumption is substantially higher than on the right side. And of course, you got the COVID ditch or whatever in the middle. But what I'm presenting then in black is the actual average. Okay. And it's plotted at the same scale just to show that because it's incremental, I'm still presenting it in a real way. And what we see is that gasoline and diesel consumption have decreased since COVID by almost 500,000 barrels a day. And that's the biggest use of a barrel of oil is gasoline and diesel. Now, I'm not going to say anything more about, I'm not predicting doom and gloom here. I'm not saying the economy is going down the drain because of this. I mean, I think we can easily, heck, I drive a whole lot less now after COVID because I don't have to go to work anymore. I do everything from home, and I don't drive my car very much, and there are a lot of other reasons, but I think that's probably something that that everybody can relate to. I don't know very many people that drive as much as before. That's what we're seeing here. So when you hear that inventories of gasoline and diesel are desperately low, and they're worried about running out of diesel at truck stops in certain parts of the country, all that's true. Why? Because we're exporting our asses off. We're sending all the diesel and gasoline we can to places like Europe because we can get a higher price for it over there. And there's nothing in the world wrong with that. Okay. That's the way capitalism works. But the result of that is that it's driving prices up for us because there's less of our own diesel and gasoline for us to consume. The next slide.
Hey, sorry, before you go on that, just want to make sure I understand. So it sounds like what you're saying is one of the reasons why gas prices are elevated here is because we're shipping a lot of this stuff off to other players because we're getting a really nice price for it as a nation. But individually, that just means I'm paying a bit of a higher price at the pump. It's not the entire reason why the pump price is higher, but it's one of the reasons.
If you had to bitch about something, that'd be what I'd bitch about.
Okay.
I said, why don't we keep it here? This is make America great again. Why are we sending all of our good stuff to other people? Obviously, I don't really believe that, but that would be a meme somebody might put out there, right?
Okay.
All a conspiracy. It's all a conspiracy. If we look at world production, this is a forecast. Well, it's actually most of it's data. Goes from 2018 through the end of 2022. So we're nearly halfway through 2022. So the rest of 2022 is a forecast, but I mean it's not a wild ass forecast. It's like 5 years in the future. This is the Department of Energy just came out Tuesday, and their forecast is that world oil production will return to pre-COVID levels this year. It's going to get to 101 million barrels a day of crude oil and refined products, which is where it was in November of 2019, which is almost the highest it's ever been, which was a year previous in 2018. So this is just a counterpoint. There's no supply to be found. Well, we're at 99.9 today as the world. That's not a forecast. It's an estimate, but it's not a forecast. According to EIA, the Energy Information Administration, which is part of the Department of Energy. So, how much of a stretch is it to get from 100 to 101 point something? Well, it's not that big of a stretch. So is this a totally outrageous and wildly optimistic forecast? No. Do I think it's going to happen? No. But it's a perspective by some people that they think about this all the time, and so that's what they're saying. So wait a minute, I thought supply was so tight that we're going to be at $200 oil. Well, not if we get back to levels pre-COVID. And what if Art is 10% right that demand is going to go down? Well, then we're going to have too much, which brings me to the last slide I'll bore you with, and that is from the same U.S. Department of Energy report. I've simply taken supply and demand, or production and consumption, which is sort of the same thing when you're looking at the whole world, okay? Basically, the difference between demand and consumption is demand is what you use plus what you export. But if the whole world is exporting to everybody else, then it ought to be the same. It ought to balance out. If you're just talking about one country, consumption could be different from demand because maybe you're exporting a lot of oil. But without wanting to confuse the issue, my point is they're not that different. And if we look at this, and again, this is data, this is not forecast except for the last 2 points. This is the balance. This is if you take world supply and subtract demand from it. Those are the columns. The blue is the difference is positive. In other words, you have a surplus. You've got more supply than demand. And the red bars are a deficit. You've got less supply than you do demand. Well, what you see is that beginning in the quarter that we're in, the third bar to the right, these guys are saying we're going to have a supply surplus of 500,000 barrels a day. And by the third quarter, it's going to be 750,000 barrels a day. And by the fourth quarter, it's going to drop down a little bit to 700,000 barrels a day. Okay, so again, I'm not endorsing this. I made the graph, but I didn't doctor the data at all. This is straight from the government. But it's a perspective and by the way, Adam, I mean, this is not the first time I've seen this. I've been showing graphs like this from OPEC, from EIA, from IEA, the International Energy Agency, for months and months and months. They've all been showing some version of the same story, that 2022, we ought to have a surplus of oil in the world. And we can argue, is it going to be 500,000 barrels a day? Is it going to be 5 barrels a day? Is it going to be 1.5 million barrels a day? And they all vary. But all I'm doing here is, like I said, I'm just providing some context, that when people say, oh, we don't know where the next barrel is going to come from. Well, there's some credible people out there. They're saying, well, gee, we can tell you. So I'll just leave it there, and we can discuss what all this means. But my sense is that the headlines are right, as they always, well, they're not always right, but as with any story, if there were no truth to it, it wouldn't last more than a day. Okay, so there is truth to the fundamental headline story that oil supply is tight and the prices are high and are likely to, if not go higher, certainly not too likely to go a whole lot lower, at least in the near term. I'm not in any way questioning that story. I'm just saying there's more to the story than the headline.
Right, which I think is really important. And yes, the charts you just showed are, none of those scream oil shortage, at least in the near term here. Now, what may really be the factor, as we talked about earlier, is, not all oil is created the same, meaning the uses of oil, the applications of oil, they require, refining and different types of refineries for the different types of grades of oil that come out, and there's diesel versus regular gas and all that stuff, right? And right now, given what's going on with Russia, it's sort of like, the game board got shook up, and everyone's spending a lot of time right now trying to figure out how to get the right supplies into the right places, and that's creating a lot of friction. That's adding a good deal of the cost here. But from what you're looking at, you don't see a reason to sound the alarm that says, hey, the world is just running dangerously tight on oil here in the near term. Might even be a little bit more on the other side of that story. And the reason why I wanted to score this is because so many people who watch this channel have heard a lot of the experts that I talk to say, hey, I'm pretty bullish on energy and oil. I think in most cases, those people are talking about a macro outlook that's measured in years, maybe even a decade. And while who knows what's going to happen with oil prices, for the rest of this year, from what I'm taking from what you're saying is there's actually, fair probability that oil prices are going to go lower this year for the factors that you just mentioned that are going to lead to demand destruction, and the fact that there's no really sort of like foundational supply shortage right now. So part of the reason why, I think it's so important to have you on here walking through what you've been walking through is, when we launch these videos, we do a live chat. People also send me emails and comments all day long. And I can see that there are a lot of people who are asking, hey, should I be jumping into oil right now? And you're a much more better expert to kind of give a nod to what you think oil prices are going to do for the rest of this year. But looking at your data, hearing what you're telling me, it really gives me caution to say, well, if I were going to invest in oil or oil services companies right now, I need to be prepared for the potential of this demand destruction that you've been laying out for us, Art. So let me stop talking and hand it back to you. Would you agree, or would you have a different perspective?
I would totally agree, Adam, and I want to caution that the part that I'm reasonably certain about is that there will be demand destruction. The part that I cannot begin to tell you, based on past instances, is when we might see that. Because in all of these cycles, and your listeners can study one or two of those charts in detail when they in their own time, and you can take the onset of inflation or oil price increase versus the onset of demand destruction is all over the place. Sometimes they nearly coincide. more often the destruction is at several months or many months in the future, all depending on the health of the economy and a million other factors that I don't want to go into right now. My advice to myself, and therefore hopefully to your listeners, is I think that energy is a good place to invest, especially because the oil and gas part of it, at least, is so much out of favor these days. We hear a lot of people talk about, well, it's been a lot of underinvestment in oil and gas. And I guess somehow maybe that's supposed to be the fault of the oil companies. Well, it's really the fault of the fact that investors walked away from oil and gas beginning in a big way back in the middle of 2018. They said, you guys are just, your returns are lousy. Why should we give you any more money? And that was an absolutely dead on. I mean, I don't understand why it took them 10 years to figure that out, but that's a whole other conversation. But that's what happened. Okay, so you can't invest money that you don't have, and secondly, all of these companies are desperately trying to win back the trust of investors. And so you hear a little bit about, or maybe a lot about, the fiscal discipline that oil companies, at least in the United States, we're not going to focus on growing production anymore. We're going to focus on returning money to shareholders. All right, and that's working to some extent. The returns are great right now. I mean, if you don't drill that many wells, you don't have a lot of capital expenditure, and you actually have wells that produce oil, you're going to make money for your shareholders.
Right, but you are setting up a future supply issue, correct?
That's the underinvestment piece of it. So there's a present underinvestment, and there's a future. But if you look at performance, I mean, the oil sector has performed like gangbusters year to date, right? I mean, much better than ESG, or really just about any part of any sector of the stock market.
Right, and sorry to interrupt, but I mean, hey, pretty easy to do that when your underlying product you sell doubles in price in the matter of a couple of months.
Sure it is. Absolutely.
But before we flipped on the recording, I think I heard you say, yeah, and really the best time to get into these companies this year was about 3 months ago.
Or 6 months ago. Sure.
6 months ago, yeah.
Yeah. I mean, so
meaning the majority of the run has probably been made, and of course we don't know with certainty, but that's what your gut sort of seems to be telling you.
The majority of the run, if all you're looking at is the macro picture of oil or energy. Now, there are individual names that have not benefited as much as others for a variety of reasons, and those might be companies that they've got some catching up to do. Those would be, perhaps good investments until that happens, if it ever does happen. So, I'm not in any way, saying don't think about energy, don't think about oil. I'm simply saying be careful, because as you said, I mean, if everybody agrees that now is a good time to get in, then it's over. Or at least the best part.
Right. And like you, what I'm not trying to say is don't invest in energy right now. And in fact, if you have a long-term horizon, I think it's probably still really good for the fundamental reasons you mentioned, Art. I'm just saying, if you put money to risk at this point, you should be cognizant that, in the near term, and by near term, I kind of mean rest of the year, the demand destruction that you're forecasting could very well come into play. And just to clarify for people, we keep saying, demand destruction, but really that's important because demand destruction leads to lower prices, right? When you say demand destruction, you're basically expecting lower pricing, right?
Right. You're expecting if everybody is working as hard as they can to produce more, and it takes months and months and months from the time you start drilling a well until you actually have any oil to sell, and this demand destruction is kind of working silently in the background and decides to raise its head in 6 months or 12 months, just about the time the new production is coming online, then you've got, the cliche of a perfect storm. You got all this new supply coming on just at a time when demand is peaking and actually beginning to fall, and then you end up with a glut and the price goes down. But the other piece that I don't want people to lose sight of is there's an economic piece. There is this GDP side that high oil prices cool the whole economy because everything runs on energy. Every single thing that's made, not just the polyethylene or whatever is in the shirt I'm wearing, but I mean everything that's manufactured requires energy to run. You got to run a factory. You got to supply parts. You've got to distribute your product. It all requires. And so if energy goes up by even a few percent, then your cost of doing business goes up a couple of percent, which means you've got to pass that on by raising your price. And so eventually the whole economy ends up slowing down because the cost of keeping the economy running is forever going higher, and it won't continue to run that way. So just the simple relationship you talk about, price oil gets higher, people use less. But what if we what if we go into negative GDP growth, as my graph suggests we will? Well, that's even worse. And then you got the Fed, as you correctly point out, and oh my God, look at all the things that could go wrong. And I'm not a doomer. Okay, I mean, people are incredibly ingenious, and I think things are rarely as bad as some people think, because they're thinking everything's going to happen at the same time and it's going to be the worst of what could happen. Usually it doesn't work out that way. So my advice is definitely look at energy and be careful.
And one other element on that. So as you know, Art, Wealthion, we have these videos that educate people, and then if they want to take action, we connect them with financial advisors. One of our financial advisors is a guy named Lance Roberts, who's based in Houston, Texas. And when he sort of advocates caution about investing in oil right now, one of the reasons why he does that is because he says, look, I've lived in Texas my whole life. I'm here in Houston amongst all the oil guys. And he says, when it corrects from an extreme, it has a history of correcting pretty quickly and pretty violently. And we only need to look back to, whatever it was, April of 2020, when oil, traded for negative dollars, for negative price for a brief period of time. And here we are, basically only about 2 years later, and we're talking about, hey, is oil going to be $150 a barrel? When they hit those low points or they hit a high point, when they reverse, they tend to mean revert pretty quickly. That's my understanding. Do you, as an expert in the space,
totally right? And I mean, 2020 is kind of a special case.
It's an extreme example, exactly.
There's a lot.
We shut the economy down.
We shut the world economy. But go back to 2018. This was back when Trump was president, and he pulled out of the Iran nuclear deal and was planning to put an embargo on Iranian oil, which is a lot, a couple of million barrels a day. And oil prices went up, to almost $80 a barrel, which from where they started was pretty nearly double. And then for a variety of reasons, not the least of which was that he decided to exempt a whole bunch of countries from the sanctions, the price collapsed down to 50 within 2 months. And so, there's a sort of a more, I don't want to say benign, because a lot of people lost money on that deal, but there's sort of a more normal kind of a situation. There 2014, when oil went from 110, which is nearly where it is, it's just a little bit higher than that now on a monthly average, and we were at $110 in June, and by Thanksgiving we were down to 70, and by February of 2015 we were down to 30.
Yeah.
Okay, so it makes your point. That's
Exactly.
exactly
You're doing a great job of giving evidence for the point, right? Hey, one question too, which is, you're expecting demand destruction to happen organically, anyways, just as things sort of normalize, um, based on the past evidence you've looked at. But there are a number of potential things out there that also could cause a really swift correction, right? I mean, there could literally, with the stroke of a pen, uh, peace could be declared in Ukraine, and the West and Russia could all of a sudden make up, and oil starts flowing a lot more freely again. China could have another bad COVID outbreak, and they could go back into lockdown for the third time. I mean, they're just these. Those are just two off the top of my head. But the point is in addition to just the organic normalization, there are other things that could happen that could really sort of change the game quite quickly. Correct?
completely. Yeah, and I mean, look at the situation with Chinese real estate. I mean, there's a huge potential deflationary thing going on there. But yeah, you're right. I mean, there are literally a half dozen or so significant things that anybody who knows the world could tick off for you and say, yeah, this could happen, this could happen, this could happen. Libya could suddenly solve its political problems and be producing 1 million barrels a day more than it is today. It's done it before many times. Easily could happen again.
Right. I guess you could say the same for Venezuela too, right? I mean, a lot of oil that's trapped.
Yeah, and in fact, I mean, right now what's happening, and then there's Iran, and it doesn't look like we're going to make a nuclear deal anytime soon with them, but the U.S. is essentially telling Venezuela and Iran right now, hey guys, we'll sort of look the other way because we really need your oil. Funny how
we hate Russia more right now. So
yeah, you're right, exactly. So yeah, but I think a point that you've made a couple of times quietly, I want to emphasize, and that is that 2023 is a different world, and a lot of what makes the remainder of 2022 potentially look like a little bit of a supply surplus goes away in a big way when we get into 2023. That, I mean, this is all. I mean, you've turned all the dials in the best way you can to maximize supply, and can you still do that as freely in 2023? And my sense is no, I don't think you can.
Yeah.
And so I could have extended all these charts out into 2023, but I didn't want to get into that level of speculation. But my sense is that back to your point, if you want to invest in oil in general, then you should be thinking long. And by long, I mean more than 2022. And if you're thinking long, which is to say at least through 2023, then you're probably good. You're probably good to be mildly bullish on oil because the world runs on it, and that isn't changing, not by 2023, no matter how bullish we are about climate change and alternate energy and all of that. So if you're looking to make a quick buck, be really, really careful. Pick your name very carefully. If you're looking to generally ride what's going on into a period of potentially lower supply, you probably do okay. But don't panic.
All right, very wise. I should let you end there because that's such a good concluding comment, but I do want to ask one last question before we wrap things up. And that is from talking with you earlier, post-pandemic, but pre-Russia or pre-Ukraine, you had talked about how you sort of thought there was a new higher floor for oil in the world, based more on, I think, sort of some of the long-term supply issues that you and I have talked about, kind of more the peak oil type mindset. Is there now a higher baseline going forward, for a floor price for oil going forward, based upon kind of the game-changing stuff we've talked that's happened this year in 2022?
Yeah, I would say, I mean, anything is possible, and I'm the one that stuck my neck out and said that things are, we're looking at kind of a new world order. I don't want to walk that back. I just want to say right now, differently probably than the last time we talked, we've got a better idea of how much Russian production will be lost, at least to the West. And it looks like it's about 2 million barrels a day. Okay, now if when we had this conversation several months ago, I don't remember if we actually talked about it, but I would have probably said 2 million for the next quarter. Okay, that was wrong. Well, I mean, and everybody was wrong. We're always wrong about this stuff. So the net loss to the market is not as bad as it initially appeared that it might. Now that could change. So that's something we know. But I think your question about kind of peak oil concerns. I mean, we're not making any more of the stuff, and we continue to make a lot more people. And so I think what we're seeing right now, I said it, and I don't want to qualify it, that what we're seeing right now is the most salient cause is trying to get things sorted back out from COVID, and now we add the Russia mess into it. But the macro mess that we're in is that we're dealing with an ever more expensive commodity as our primary source of energy. And as oil price goes up, the price of renewable energy goes up too. It costs, everything that goes into that solar panel or that wind turbine uses energy mostly from fossil fuels to mine it, to ship it, to manufacture it, and to distribute it. So, if we're feeling pain in the market because steel prices are more and a car's costing more and food prices are more, well, so are renewable energy providers. So the bottom line, Adam, is that there's no likely way that I can foresee that the cost of energy overall is going to do anything but climb higher. And so on the one hand, that creates a problem that doesn't really have a solution. On the other hand, it creates an opportunity for investors who have at least the right sense or the right advisors to help them see the right sense into how to invest in that.
All right, great. Well, look, I'm going to earmark that your answer there, Art, as the jumping off point for the next time we bring you on the channel to really dive deep into that, the big macro outlook around energy in total. Well, look, Art, thanks so much for coming on and sharing such great data and perspective with us on such an important topic. For folks that would like to follow you and your work going forward, where should they go?
artberman.com or at aeberman12 on Twitter. I'm active in both places. If you can, if you just want to get the brain dump daily, Twitter is a good place to go. If you want it explained a little bit more carefully, go to artberman.com.
All right, great. When we edit this, Art, we'll put the URLs up on the screen here. But as a avid consumer of both channels, highly recommend folks go follow Art in both those places. Also, if you want to see the report that we talked a lot about today, Art's report there on oil demand destruction, just go to wealthion.com/oil demand, and we will connect you with that report. If you enjoyed having Art on here, you'd like to see him on again and other great experts like him, please do me a favor, support this channel by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. Art, it's been a real pleasure having you on. Thanks so much for joining us. And everybody else, thanks so much for watching.
Thanks, Adam.